The main point here is that monetary policy is not about interest rates, it's about changes in the money supply. So there are really two things that would affect the rate of growth in the money supply that are.
Hello everyone and welcome to another edition of Triangle Investor Interviews. I'm your host Lucian Valkovic, and before I announce my guest, just a reminder of a disclaimer. This interview and all my interviews are not a recommendation to buy or sell any shares, products or services. Always do your due diligence and consult with your financial advisor. My guest today is Steve Hanke, a professor of applied economics at Johns Hopkins University in Baltimore, a distinguished senior scholar at MZ Institute, and the author of Making Money Work, which was released, I believe, in May this year. According to Focus Economics in Barcelona, this professor is the world's third most influential economist. That is really impressive. You can follow Professor Hanke on X. His handle is Steve_Hanke. Professor, great to have you back in my show. Welcome.
Great to be with you, Lucian. By the way, the handle it has to be at Steve_Hanke. Put the at before Steve. Yeah.
Exactly.
Anyway.
Yeah, we will leave that in the description of this video as well. Professor, let's start maybe with monetary policy and currencies. Given the Federal Reserve recent focus on interest rates, you emphasize that money supply is the key driver of economic trends. With US money supply growth still below golden 6% rate, what specific policy adjustments should the Fed prioritize to avoid the potential recession?
The main point here is that monetary policy is not about interest rates, it's about changes in the money supply. So there are really two things that would affect the rate of growth in the money supply that are on the agenda, shall we say, of the Fed. And one is they should stop what they call quantitative tightening. You know, they've been shrinking the size of the balance sheet at the Fed, and if they stop the quantitative tightening, obviously that would loosen. That would make things looser, and the money supply growth rate would pick up. The other thing is the regulation of banks. And right now, and this is really since the great financial crisis in 2008, they had something called a supplementary liquidity reserve ratio that was put on the banks. And that does constrain their lending, and it's totally absurd because they have to have liquidity and reserves against U.S. government bonds that's the same as other much more risky assets. So it is a very primitive regulation that was thrown in on the banks, and they are talking openly in the Fed about getting rid of that. And that gets back to you mentioned the book that was just released in May, Making Money Work, and there are really three aspects of that book that are fundamental and quite important. One is reintroducing the whole idea of the quantity theory of money back into macroeconomics. And that means changes in the money supply have consequences. Money dominates, and changes in the money supply work their way through the asset markets, the real economy, and obviously inflation. That's the first point. The second point that we get into are bank regulations, because a big factor in monetary policy are regulations that are placed on banks. Most people never look at these, they don't understand them, but remember, banks produce about 80% of broad money in all countries, by the way. Most people think the central banks produce the money. No, the central banks produce some of the money, but the elephant in the room are the commercial banks. And as a result, bank regulations are something that we pay a lot of attention to, and that's the second leg. The third leg is what we focus on is money neutrality. Monetary policy should be designed not only to keep the rate of growth in the money supply at a steady stream and constant and not volatile, but it also should focus on neutrality. And what I mean is that the changes in the money supply shouldn't be affecting different sectors of the economy in a massively different way, or different individuals or classes of individuals. This gives an example of the non-neutrality that we have now. When COVID started in February of 2020, of course, the Federal Reserve increased the money supply very rapidly, and at one point it was growing at around 18% year over year. That's as high as the money growth has ever registered since the Fed was founded in 1913. So what happened? Well, what happened, of course, with a lag, asset prices went up. Now, what asset prices? Well, you had real estate went up, land prices went up, the stock market went way up, and eventually the economic activity went up. And then eventually inflation went way up and hit 9.1%. And using the quantity theory of money, by the way, John Greenwood and I indicated that the inflation rate would go up to as high as 9%. Well, it actually went up to 9.1%. So we were pretty close using the quantity theory of money as the macroeconomic model, and this idea that money dominates and changes in the money supply have tremendous effects on the real economy and on inflation. So getting back to the neutrality thing, what happened? Well, who owns all the assets? Well, rich people own the assets. Middle class people, their balance sheets, they probably have almost nothing positive on the balance sheet. And poor people, it's negative. So the billionaires' wealth as a percent of GDP in the United States, U.S. billionaires' wealth as a percent of GDP, was 14.1% in January of 2020. Today, it's 21.7%. So the non-neutrality was enormous because of the Fed's policy, and the income distribution became much more unequal after this non-neutral surge in the money supply. So the 3 points that Matt Sakurki and I make in the book, Making Money Work, which by the way, even in Croatia, you can buy this it's on Amazon and all these internet sites for sale. So we make 3 points. Money dominates, and if you want a macroeconomic model that is realistic and tracks well, you have to use a quantity theory of money. Second thing is that bank regulations are a big part of monetary policy, and the reason why they are regulations of banks affect the rate of growth in the contribution to the money supply made by commercial banks, which is the elephant in the room. It's in the U.S. It's about 80% of M2. The stock of M2 has been produced privately, not by the Fed, privately by commercial banks. And the third thing is this neutrality, the idea that monetary policy should be neutral as you can make it, not distorting income distributions or favoring one sector versus another sector of the economy. So that's kind of a long answer, but
very good answer. Very good answer. Yeah, Professor, in your recent discussion, you've described tariffs as a house of cards, contributing to a trade war doom loop. How should the US adjust its trade policies in this year to mitigate the economic uncertainty and prevent further escalation with major trading partners, of course, like China?
Well, okay, this goes back. I have to identify myself in a way, and remember, I was one of Ronald Reagan's advisors when Reagan was president. And I am a classical liberal economist. I'm a free market economist, and I'm a free trade economist. Now, what does that mean? That means I'm against all sanctions, I'm against all tariffs, I'm against all quotas, and I'm against all non-tariff barriers. So, what do I think they should be doing? I think the U.S. should be eliminating tariffs. I think the course that the U.S. is on right now is a disaster. The average effective tariff rate now is a little over 18%, and that's as high as it was in 1933 when we introduced the devastating Smoot-Hawley tariffs that helped plunge the world into a Great Depression. So we're headed in the wrong direction, and the reason for that, there are many reasons for it, but the economic analytical reason for that is that the President Trump, has identified the trade balance and the deficit in the trade balance as being bad. He says that's bad. And the reason he says it's bad is he thinks foreigners are manipulating, or as he put it, they're screwing the United States. Somehow foreigners are causing all of this deficit, and it's bad. And the fact of the matter is, the trade deficit is caused by Americans. It's not caused by foreigners. And to get a handle on this and understand it, the Americans spend more than the value of the gross national product. And to fill that gap between the spending that exceeds gross national product, the gap has to be filled by what? By a trade deficit. And the trade deficit is exactly equal to the overspending relative to GDP. So for students who are listening or people who are serious, you learn what? Consumption plus investment plus government spending plus the net trade balance equals GDP. So that's just an identity in national income accounting. So if you have consumption plus investment plus government, that's the spending. If that's greater than GDP, the number that you add for the international balance will be negative. That'll be a trade deficit. So the president just has everything all wrong. It's all wrong, and I think unfortunately we're going to be stuck with this because he believes it, and all of his associates that are basically kissing the ring of the king, they repeat the same thing that the king repeats.
Yeah.
So I think we're in big trouble, and the United States, by the way, getting back to where I think the United States economy is going, I think we're on the verge of going. We're slowing down for sure, but I think we are on the verge of going into a recession, and the reason for that is that the money supply has for about 2.5 years actually been contracting. Now it's growing a little bit, but it's growing at a very slow rate. 4.5% is the year-over-year growth rate in the money supply measured by M2 in the United States, and Hanke's golden growth rate, a rate consistent with hitting the inflation target of 2%, is 6.3%. So it's growing. It's growing slowly, not fast enough. And by the way, coming back to our first point that we were talking about, that's why they should loosen up monetary policy, and the best way to do that, get rid of quantitative tightening and get rid of this supplemental liquidity ratio on the banks. Because, by the way, the banks' contribution to the broad money supply M2 in the United States, that not surprisingly, that happens to be growing also at 4.5%.
Yeah, Professor, you did warn of an 80 to 90% chance of US recession in this year, citing money supply constraints and regime uncertainty. What are the most critical indicators investors should monitor in the coming months to prepare for this potential downturn?
Well, I that's a little that's a little bit hard to say, in the following sense. There isn't one specific magic bullet. The point is, we've had this slowdown in the money supply, and that happened a long time ago. And that's why the slowdown is like baked in the cake. But the cause is the change in the money supply that occurred back in 2022, 2023, 4, and currently. So that's the cause. And when you say what indicators, well, those indicators, they're just symptoms of the fact that the money supply slowed down a long time ago. So that's why in a way they're kind of irrelevant, because the cause of the slowdown is something that happened a long time ago, and most people don't even look at it anyway. Most people are trained with neoclassical macroeconomic models, especially the young people, not the quantity theory of money. So that those neoclassical models, they don't even include an aggregate for money. Money isn't even in the model. So they're all trained to do what they do. They're data dependent. They look at all these little data points that are coming out day after day after day, and they think they're the cause of something. But actually, they're the symptom of what happened to the money supply a long time ago. So uh, that's why I say it's hard to give a coherent answer,
Sure.
because I'm just not data dependent. I look at the data, I watch the data, and I try to anticipate what's going to happen. But I'm looking what the engine for it all is what was going on in the money supply a year ago, 2 years ago, 3 years ago. That's where you have to analyze things.
That's a
And then
fair answer, yeah.
on top of it, you mentioned regime uncertainty, and the regime uncertainty is added to what's baked in the cake. What's causing the data to move the way it's moving is what was going on with the money supply a long time ago. Now we have something that is current, and it is more uh, on the daily radar screen, and that's the Trump regime uncertainty. Because what does regime uncertainty mean? We always have uncertainty, little pockets of uncertainty here, there, at different places, or if you look at a specific company, they have particular risk and uncertainties and so forth. But regime uncertainty is something that's not very common, and that's when all the rules of the game are changing. Think about, look at it this way. Think about, you're there in Zagreb today, and think about in 1990, at the end of 1990 and going into 1991, the Civil War came. You had everything was changing. So there was a lot of regime uncertainty
Yeah.
associated with that transformation from the old socialist worker managed kind of economy in Yugoslavia to something that was much more liberal. I'm not saying it was necessarily free market, but it was going from one end of the spectrum towards, let's say, changing and going towards the middle. Now, in the United States, the best example, we haven't had much regime uncertainty. The only real regime uncertainty we had was in the 1930s when Franklin Delano Roosevelt was elected, and the New Dealers came in. And they were on the left. They were on the left. Trump is identified as being someone on the right, but you can be right, left, center, and any a communist, a capitalist, any of those things can create regime uncertainty if they start changing all the rules. So the New Dealers in the 1930s, they were changing everything. In fact, they made they they invalidated the gold clauses in contracts. So that was just outright theft going on. So, and a lot of new bureaus, they tried to stack the Supreme Court. All kinds of things were changing. And what happened, you had regime uncertainty, and the investment in the United States was essentially zero from 1929 until the start of World War II. And that's the regime uncertainty, because people don't want to invest if they don't know where the roadmap is. And they don't have a good idea of what EBITDA is going to be or free cash flow is going to be if they make an investment. So that's where we're at now, and I think I think the stock market just isn't picking up on this at all. I think the stock market's in a speculative bubble actually in the United States.
Yeah, agreed on that, definitely. Let's move to gold. You've noted that the gold is outperforming stocks by a factor of 4, and that we are, of course, in the bull market. What factors are driving central banks to source gold domestically, and how should investors position themselves in precious metals versus equities in this year?
Well, I think central banks they've been buying now for a couple of years, but they as you indicated, one little thing that's changed, they're buying from local sources, national sources. So that one reason for that is this trade war that Trump has started. And that's why some countries are even have pulled their gold reserves out of New York back to, in case of Germany, back to Frankfurt. So that is why it switched from global to local sourcing, but the demand is actually the uncertainty into the picture, and the central banks have been buying, and when I say uncertainty, I mean what? We were talking about the trade war, but remember, the big thing going on has been the weaponization of the U.S. dollar and the U.S. dollar financial system. The freezing assets that are owned by Russia, for example, they're frozen in Europe, and the weaponization, the sanctions, and tariffs are in the same family of interventionist activities, and they're basically, I view them as weapons of war. So this is another reason that a lot of central banks, particularly one of the big buyers, by the way, has been China, and obviously in Russia. So all these countries in the South and the BRICS, for example, have been buying heavily because they're afraid of the U.S. dollar. They don't want to get trapped holding U.S. dollar assets, so they want to balance their portfolio. So at the margin, they've been adding a lot of gold. Now, in addition to that, you've had a lot of private buying by the Chinese, and the Chinese, the reason for that private buying, not only the weaponization of the U.S. dollar, but the local conditions. Remember, we had the real estate bubble popped in China, and the Chinese economy, since COVID and the lockdown in China, it's struggling, and people and the Chinese are doing what? As a result of that, they're saving more and consuming less of their income, and they're piling into private purchases of gold rather than the Chinese yuan. They don't trust the yuan.
Yeah. Professor, as a proponent of Austrian economics, how do you see its principles, such as quantified theory of money, guiding central banks away from current policy missteps, especially in the light of the recent inflation pressures and debt crisis?
Well, let me step back and look at the whole scene as an Austrian free market economist, and that is one institution that we have since the Bretton Woods arrangements after World War II is the International Monetary Fund, and the International Monetary Fund is basically a failure because you have tremendous recidivism. The countries that are involved in borrowing money from the IMF are in a doom loop. They just accumulate a lot of debt, and then they have to get bailed out again, and then again and again. So let's take the biggest country that is the biggest debtor to the IMF, Argentina. And Argentina is basically a deadbeat because they keep defaulting on their debt and keep adding debt. And even they have a new president, Milei, who claims, by the way, he's an Austrian economist. And that he embraces Austrian economics. But since he's come in, he hasn't followed through on his promise to dollarize the economy and get rid of the peso. This would be something like I did, by the way, in your neighbor in Montenegro. In 1999, I was President Djukanovic's chief advisor and a state councilor in Montenegro, which was then still part of the rump Yugoslavia. And what did we do? We made the German mark legal tender, and we, in quotes, dollarized Montenegro. And Montenegro still today now, as of 2002, of course, when the German mark disappeared and was replaced by the euro, then Montenegro replaced the German mark with the euro, but they're not formally in the eurozone. They're de facto in because we dollarized it in 1999. Now, getting back to Argentina. Milei was elected, campaigned on dollarization, getting rid of the peso. He didn't do that. He didn't follow through on his promise. Instead, he's actually added the IMF has loaned them even more money, $10 billion more. So now instead of owing the IMF $44 billion and being the largest debtor to the IMF, now Argentina owes them $57 billion. And the reason this is a doom loop, I just recently did a calculation of capital flight from Argentina since 1995, and 68% of all 68% of the accumulated debt that the debt comes in the front door, but it goes out the back door, 68% of it. It goes to Montevideo, New York, London, Zurich. Huge capital flight. And then what happens? Then Argentina has to go back and borrow more money from the IMF, and it leaks out again through capital flight. And this is the doom loop that goes on. So, as an Austrian, if you want to shut down the capital flight and keep foreign direct investment, by the way, the capital flight is a percent of foreign direct investment in Argentina since 1995 is 84%. So it's almost all the foreign investment basically just escapes with capital flight. In the front door, out the back door. So the way to solve this, and I've been advocating this for many years, and that is there are only two ways to do it. And that is to put confidence in the currency that's being used. Because the reason there's capital flight is that people don't trust the currency. They want to leave because they think the currency is going to collapse. So one way to do this is what I've done in actually Estonia, Lithuania, Bulgaria, Bosnia-Herzegovina. They have currency boards. And the currency board is a monetary institution that emits a local currency, but the local currency trades at a fixed exchange rate with an anchor currency, and the anchor currency is reserved at 100% against any local issuance of money. So the local money is as good as the whatever the anchor happens to be. In Bosnia-Herzegovina, they call it the convertible marca. It's just a clone of the euro because the euro is the anchor currency, and it's credible because 100% reserves. You know if you're going to take your convertible marca in to the currency board, you're going to receive euros at the fixed exchange rate because the requirement is that you have to have euros at 100% reserve. So that's one way to stop it and have confidence in the currency. Make the local currency a clone of some stronger anchor. The other way is just to do what we did.
Yeah, what about poor countries?
What?
Yeah, Professor, what about countries like Ethiopia with 50% inflation rate and currency depreciation? What currency reform measures can you apply over there to stabilize their economies?
I do exactly what I did in Bulgaria in 1997 and put in a currency board. It would stop it immediately. In Bulgaria, the inflation rate, by the way, when I was President Stoyanov's advisor in 1997 until 2002, actually, but in 1997, the inflation rate was the 13th highest hyperinflation in world history, and that inflation rate was 242% a month.